Okay, let's unpack this. If you've ever tried to manage money while, moving across continents, you absolutely know the pain. The unexpected card freezes, the crazy exchange rates, and that just terrifying moment when a bank demands proof of residence that you simply don't have. Today, we are deep diving into this really revolutionary class of financial tools that are designed to solve this exact headache, the rise of crypto debit cards.
And we've got a really comprehensive stack of material here. It covers, well, everything from the underlying technical models to the strong philosophical appeal of privacy that's really driving adoption. Our mission for you, our listener, it's clear. We're going to distill the complex mechanics, we're going to weigh the specific trade-offs, and give you a really sophisticated understanding of this landscape. And we'll be featuring platforms like PintoPay as a key case study.
Right, and we're serving two pretty critical audiences here. First, you have the true global nomads, the travelers who are literally living their lives bouncing between time zones and jurisdictions. And second, a very motivated demographic that's focused on financial autonomy, on reducing oversight.
The no KYC crowd.
Exactly. The people demanding no KYC solutions, and also those who are genuinely unbanked, meaning they just lack access to traditional banks altogether.
It's so crucial we address both of those needs at the same time. And to start, let's just clarify those core terms because they're central to the whole appeal. When we talk about KYC, we mean know your customer. It's the regulatory process banks use to verify who you are, where you live,
All that paperwork.
all that paper, and the unbanked. I mean, they aren't just privacy advocates. These are often individuals in emerging markets or maybe marginalized groups for whom traditional finance is just. It's not an option. So our deep dive is really exploring the tools that promise a way around those gatekeepers.
Exactly. So let's start at the very beginning. Why are crypto cards even necessary? I mean, what's so broken?
The traditional system, which often relies on these archaic tech stacks and very rigid country-specific rules, it just fundamentally fails anyone who doesn't fit that static model of living in one place.
The sources paint a pretty grim picture of that failure, don't they?
Oh, they do. We can really break the friction down into three catastrophic pain points. First, the random freezes.
Ugh, the worst.
Right. Your bank's fraud algorithm sees you make a purchase in, say, Thailand 5 days after one in Portugal and just, boom, flags the card, instantly paralyzes your ability to spend.
It's technology failing to keep up with how people actually live now.
Precisely. And it's always unexpected, always urgent, and you're always somewhere remote where trying to call international customer service is just a multi-hour nightmare.
And then there's the other issue, the constant cross-border friction. Even if the card isn't frozen, the transaction might just fail.
Yeah, due to these subtle differences in, like, chip protocols or regional payment systems, sometimes it's as ridiculous as different time zone data causing sync errors.
But the most severe hurdle, and this is the one that I think really defines the need for these alternatives.
It's the proof of residence trap.
Yes.
If you're a global professional, a digital nomad, you're constantly migrating. Just keeping a bank account open becomes this bureaucratic nightmare. The bank demands a utility bill from an address you might have left months ago. It effectively forces you into a corner. Either you stay put or you risk losing your financial access.
So traditional banking is basically optimized for stasis. It assumes you live in one place, earn in one currency, and you rarely cross a border. If you violate that assumption, the system actively works against you. And that creates this huge multi-billion-dollar opportunity for truly borderless finance.
What's fascinating here is that this systemic failure is precisely what crypto cards are engineered to counteract. They completely shift the trust mechanism. The core promise is, well, it's simple. The ability to pay anywhere with crypto. You hold Bitcoin or another token, and the card just instantly converts it to the local currency dollars, euros, yen, right at a point of sale.
And it works wherever standard Visa or MasterCard is accepted.
Globally.
Okay, but doesn't that reliance on Visa and MasterCard, the traditional payment rails, doesn't that undermine the promise of true decentralization a bit? I mean, are we just trading one gatekeeper for another?
That's a great question, and it's really the necessary compromise for getting mainstream utility today. The power shift isn't about avoiding the transaction network itself. It's about eliminating the need for the bank as the intermediary.
Ah, I see.
The bank is the one demanding the KYC, the one deciding whether to freeze your funds based on your location. This shifts control from a slow, legacy banking core to a much more agile, independent payment processor.
That makes a lot of sense. So the flexibility of where the funds come from is the revolutionary part. Let's look at how the sources actually classify these solutions. If someone listening wants to jump into this space, they really need to understand the landscape, which is broken down into three types.
Exactly. And this segmentation, it really helps us understand the trade-offs, convenience versus global applicability.
Okay, type 1. The exchange-based solutions.
So these are the cards tied directly to a large established crypto exchange. Think Coinbase or the old Binance card. Their key advantage is just simplicity. Your card is linked right to your crypto holdings on that platform. Easy.
But there's a huge drawback.
A massive one. Geo-restriction. Because these large exchanges have to comply with very stringent national regulations, they are often unavailable in the exact regions where a global nomad would need them most.
So if you're trying to escape that proof of residence problem, an exchange-based card might not actually get you out of the country.
Precisely. Which leads us to the second option, the more independent, flexible model,
Yeah.
the fintech solutions. These are companies built specifically to solve this global movement problem. They operate outside the direct control of the major exchanges, and they're engineered to minimize those geo-restrictions that plague Type 1.
And this is where a solution like PintoPay fits in.
This is exactly where it's positioned.
And finally, type 3. This one's a bit less visible. White label solutions.
Right. The white label solutions are the infrastructure providers. Think of them as like the plumbing. They build the technical bridge, the payment processing, the crypto liquidation engine, and then they lease that whole structure to other brands who want to launch a crypto card under their own name.
So, while you as a consumer might never use a pure white label product, its existence is why we're seeing so many of these specialized crypto cards pop up.
Exactly.
So, to circle back to our case study, PintoPay is classified as one of these independent fintech solutions, and it's specifically built for global movement. It promises zero border friction in over 150 countries.
That's its clear market positioning. It's aiming directly at dismantling that proof of residence trap.
So it's aiming for that sweet spot, global reach, but with the convenience of instant fiat conversion.
Yes, that's the goal.
So now we move on to the benefits, and this is where we really have to deliver that deep analysis our audience expects. We've covered why they're necessary. Now let's cover why people want them. We often hear comparisons to modern digital banks like Revolut or Wise. Why choose a crypto card over one of those?
Well, the difference really lies in the source of the funds and the intent of the user. Digital banks are fantastic for fiat flexibility, but they are still fundamentally reliant on traditional banking licenses.
Which means they still require KYC.
They still require KYC, and they can, in theory, be subject to the same geopolitical freezes or even asset seizures.
But a crypto card fundamentally bypasses that entire system because it lets you leverage self-custody assets.
Exactly. And for the traveler, the features are really tangible. Worldwide acceptance, seamless integration with Apple Pay and Google Pay, and critically, a promise of no hidden border fees.
That's a big one.
A huge one. I mean, digital banks have lowered these fees, for sure, but the crypto card model can often offer an even more competitive rate structure, making those death by a thousand cuts conversion fees a thing of the past.
Okay, here's where it gets really interesting, though, and it requires a bit of a technical detour. How does the card manage that instantaneous conversion? I swiped my PintoPay card in Tokyo, the purchase is in yen, but my balance is in Bitcoin. How does that happen in milliseconds?
This is the core technical achievement, and it happens in 3 super rapid stages. First, the payment terminal sends the request in yen through the normal Rails, Visa, or MasterCard. Second, the card issuer, PintoPay for example, instantly talks to its liquidity provider, an exchange or a trading desk, to trigger a fractional sale of your Bitcoin to cover that exact yen amount.
And third,
The processor confirms the fiat settlement back to Visa, and the transaction is approved. The entire thing, crypto sale and fiat settlement, has to happen in less than a second to avoid the machine timing out.
that speed. That's the game changer. It's integrating a decentralized asset into a centuries-old payment system. But this brings us to the biggest hook for a lot of users: privacy and freedom. The source material specifically notes that searches for no KYC and anonymous crypto spending are trending way up.
That desire for anonymity drives massive traffic to these solutions. It's not just about avoiding bank bureaucracy, it's about demanding a financial separation from traditional oversight. The pitch is so compelling. Did you know you can spend your Bitcoin at the grocery store without a bank even seeing the transaction?
That specific example really connects this abstract idea of financial freedom to just daily life.
Hmm.
They want their spending footprint to be invisible to the legacy system.
But, and this is where we have to apply some critical analysis because, true, verifiable anonymity is much, much harder to achieve than simply not using your bank account.
Go on.
So while the transaction on the Bitcoin blockchain is pseudonymous and your bank doesn't see your crypto balance, the card transaction itself is not anonymous.
So what data is still exposed and to whom?
The centralized infrastructure still demands information. The payment network,
Yep.
so Visa or MasterCard, they see the essential transaction metadata. The merchant category, like groceries or air travel, the exact time, the location, and the fiat amount. And what's more, the card issuer itself still holds crucial data. So even if a card claims no KYC, that often just means no government ID check is needed for, low spending limits.
Okay, so if I buy milk with a no KYC crypto card, my bank doesn't see it. But the payment network knows I bought milk in Tokyo at 4 p.m., and the card issuer knows the unique card ID that made that purchase.
Exactly. And for users who are seeking absolute anonymity, maybe for personal security reasons, this distinction is critical. They're trading the deep financial oversight of their bank for the more localized metadata oversight of the card issuer and the payment network.
And the sources emphasize setting realistic expectations here.
They really do. Acknowledging that true anonymity in the regulated financial world is, it's rapidly becoming technologically impossible because of global anti-money laundering regulations.
That is a really powerful nuance. The challenge is, as these global cards like Pinto Pay, as they expand, they inevitably attract more regulatory scrutiny, which means their ability to offer true no KYC is probably going to diminish over time, especially as spending limits go up.
We've already seen that trend play out globally. I mean, the promise of zero border friction in 150 countries is incredibly appealing, but achieving that scale necessarily means you're interacting with all these different national financial laws.
Which almost always lead back to some form of ID verification.
Even if it's minimal at first, yes.
So what does this all mean for the listener who's trying to make a choice? We've analyzed the systemic failure, the three solution types, the tech, and the difficult trade-offs of anonymity. How do we provide that clear decision framework?
We just have to reiterate that there is no single best option. It's not one size fits all. The choice hinges entirely on your primary goal. Are you looking for maximum convenience and you're already happy with your exchange wallet? Okay, go exchange-based, but you have to accept the geo restrictions.
But if you're a true global nomad, trying to eliminate that proof of residence hassle and the constant cross-border friction,
Then freedom of movement is your goal. And in that case, the independent fintech solutions, the model Pinto Pay, represents. That's your target.
right.
They're the ones built from the ground up to solve that geographical flexibility problem. They promise that zero friction in 150-plus countries. They might require a bit more setup, sure, but they deliver on that core promise of financial mobility. You just have to think critically about the nuances. Are you optimizing for the lowest fees, or are you prioritizing that highly valued separation from the legacy system?
The ultimate choice is really a balancing act between convenience, regulatory compliance, and your own personal threshold for how much data you're willing to share. It's about matching the tool to the specific need, whether that's just simple everyday spending or it's maintaining financial independence while you're constantly crossing international lines.
This has been a deep and, I think, a really necessary dive into a sector that's evolving so quickly. The core takeaways are that traditional banking's rigid reliance on static residency and archaic fees. That's the main driver. That's what's pushing users to alternatives.
And those crypto card solutions come in three distinct categories: exchange, fintech, and white label, all delivering those essential travel features like zero border fees and that highly sought-after anonymity.
Though we now understand the very real limits of that anonymity.
And that leads us to the final thought we want to leave you with. It's one that connects all the way back to that original friction point of proof of residence. If traditional banking is structurally designed to require identity linked to a physical location, and the technology of crypto cards is engineered for completely borderless, instantaneous global spending,
then how might the escalating global regulatory demand for KYC for identity verification, how will that fundamentally adapt to or maybe clash with the underlying technological promise of true unmonitored financial flow across 150 countries? That inevitable regulatory convergence, that's the next big hurdle that will define the future of global finance.